Welcome to the deep dive. We're here to cut through the noise and get you, well, truly informed.
That's the plan.
Today, we are plunging into QuantumScape, ticker symbol QASIS. It's all about the future of electric vehicle batteries, super complex, really high-stakes stuff.
Absolutely. A lot to unpack there.
Before we dive right in, just a quick note. This deep dive is brought to you by Stock Analytics AI. If you find this useful, please do like and subscribe to our channel.
Yeah, it really helps us out.
And members, for just $4.99 a month, you get priority deep dives on specific tickers you ask for. We're actually covering all of the S&P 500 stocks over the next few months, and members get that exclusive priority access.
Big deal.
And hey, if you just want a one-off deep dive on a particular stock, you can always drop us a super thanks.
We appreciate that.
Okay, so QuantumScape. Look, this company isn't just, tweaking existing batteries. They're promising a breakthrough.
A fundamental one.
Exactly. Something that could totally rewire the entire EV industry. Think about it solving those core problems holding EVs back. Range anxiety.
Charging speed.
And safety. Big ones. Now, the tech, they've shown demos.
Right. The partnerships, especially VW, are in place.
And the market potential.
Yeah.
We're talking trillions. Potentially.
It's huge.
But, and this is the kicker, right? Zero revenue, staggering losses, and this long, pretty treacherous road to actually making these things at scale.
Yep.
So you've got to be asking, is this the next Tesla? Or is it just, a high-tech Mirage that's going to burn through billions of investor cash?
That really is the multi-billion-dollar question, isn't it?
It is. So we're going to unpack every facet of this company, understand the opportunity, yes, but also the profound risks.
That's precisely the tightrope we're walking today. QuantumScape has potentially disruptive tech, no doubt. But like you said, getting it from the lab into millions of cars, that's a monumental hurdle.
Immense.
Our goal here is to give you a balanced, critical look, both sides of the coin, so you can navigate this high-stakes situation.
And that's our mission, really. We take your sources, the articles, the research, the notes you'd gather, and we distill it. Pull out the most important nuggets of knowledge to help you get properly informed on QuantumScape.
Maybe find a few surprising facts along the way.
And hopefully keep you hooked. One quick but important note. All the financial data, market metrics, strategic stuff we talk about, it's all as of September 8, 2025.
Right.
And QuantumScape's closing share price on that day was $7.86, just for context.
Good context to have.
Okay, let's unpack this. We've got our structured deep dive ready. 7 key chapters to break down this complex company.
Let's do it.
First up, Chapter 1, business analysis. So, to kick us off, how does QuantumScape actually plan to make money? What's the core business model here? It's not typical, right?
No, not at all. It's what you'd call pre-revenue, obviously, but also IP-rich and strategically capital-light. That last part's key.
Capital light, what does that mean in practice?
It means they don't plan on building dozens of these massive multi-billion-dollar gigafactories themselves.
Ah, okay, so they're not trying to be Panasonic or CATL directly.
Exactly. The strategy is perfect the core technology, perfect the manufacturing process for the key components like that ceramic separator, and then license that intellectual property, the IP, to big partners who already know how to manufacture at scale.
Like Volkswagen's PowerCo.
Precisely. So revenue comes in 2 planned phases. Near term, you've got development and milestone payments.
Okay, like progress payments.
Right. For instance, in Q3 2025, they expect to bill PowerCo over $10 million for hitting specific development targets.
Oh.
Crucially, that's non-dilutive funding. It's cash without selling more stock.
Got it. And long term?
Long term, the big prize is royalties and licensing fees. High-margin recurring revenue. Basically, they get a cut for every single battery unit their partners produce using their tech.
So they offload the massive cost and headache of building factories.
Exactly. They avoid, or hope to avoid, what people call manufacturing hell. It shifts a lot of the capital burden and the execution risk onto the partners.
That does sound clever, if the tech works and if the partners can scale it. So what exactly is the product that's being licensed? What's the core innovation?
Well, the main product right now is the QSE-5 solid-state battery cell. It's about 5 amp hours. They're currently shipping what they call B samples.
B samples, so later stage prototypes.
Yeah, basically for automotive customers to test and validate. But the real magic, the core IP, is in 2 things. First, that proprietary solid ceramic separator.
Right, the thin ceramic sheet.
Exactly. It replaces the flammable liquid electrolyte you find in, conventional lithium-ion batteries. It's non-combustible, which is huge for safety, and enables better performance.
Okay, safety's a big plus. What's the second innovation?
The second one is maybe even more radical. It's their anodeless cell design.
Anodeless. How does that work? Don't batteries need an anode?
Traditionally, yes. Most batteries are built with a physical anode, usually graphite. QuantumScape eliminates that factory-built anode.
So, what happens?
A pure lithium metal anode forms in situ. That means it basically plates itself onto the ceramic separator during the very first charge cycle.
Whoa. Okay, that is radical. Why do that?
Big benefits, potentially. It dramatically increases energy density because you remove the dead weight of the host material like graphite. It also simplifies some manufacturing steps and could potentially reduce costs.
And they have a special process for making the separators.
Yeah, they call it Cobra. It's their new platform for manufacturing those ceramic separators much faster. They announced it hit baseline production in June 2025. Apparently, it's got like a 25-fold improvement in throughput compared to the older Raptor process. Speeding that up is critical for scale.
Okay, this anodeless idea, it genuinely sounds like something out of science fiction. Why is getting rid of the anode such a big deal, and what could it mean for us, driving EVs?
Well, the promise, the holy grail they're chasing, is what they call a no-compromise battery. It aims to solve 5 key problems all at once.
5. Okay, lay them out for me.
1. Higher energy density. Over 800 watt-hours per liter. What that means for you is potentially 15–40% more range. So maybe your 350-mile EV becomes a 400 or even 500-mile EV.
That's significant. Okay, what else?
2. Faster charging. They claim 10% to 80% state of charge in under 15 minutes.
Seriously, under 15 minutes, that's huge.
It would be. 3. Enhanced safety. That non-combustible solid ceramic separator helps prevent thermal runaway battery fires.
Always good. Number 4.
Longer lifespan. They're targeting over 95% capacity retention after 1,000 charge cycles. That's roughly equivalent to, say, 300,000 miles of driving.
So the battery lasts longer than the car, potentially?
Potentially, yeah.
Yeah.
And finally, 5. Lower cost potential. Because you eliminate the anode materials like graphite and the associated manufacturing steps.
Right, that anodeless design again.
Exactly. So that's the value proposition. But it's crucial to remember they're still a development stage company. Pilot production in San Jose, California. Full-scale commercialization is still targeted for, 2026, 2027.
And yet, their market cap is already around $4.45 billion, even with zero revenue.
Right. The market is clearly pricing in a lot of that future potential, that promise.
Okay, that's a very compelling promise. But surely they aren't the only ones working on this. What's the competitive landscape look like? Is it crowded?
Oh, it's definitely crowded and incredibly well-funded. The market trends are obviously fantastic, explosive growth expected for solid state, driven by EVs, grid storage. Forecasts are talking maybe $2–3 billion in 2025, growing to over $33 billion by 2033. Huge KGR numbers.
So everyone wants a piece of that pie.
Everyone. You've got direct solid-state competitors like solid power ticker SEEP. They're partnered with Ford and BMW. There's SES, AI ticker SES, doing a kind of hybrid lithium metal thing.
Okay, other startups.
Then you have the established battery giants, CATL, Panasonic, Samsung SDI, Northvolt in Europe. They're constantly improving traditional lithium-ion, and they have their own solid-state R&D programs.
The incumbents aren't standing still.
Not at all. And you also have the car companies themselves, the OEMs. Toyota has been very vocal about their solid-state efforts. Hyundai, too. Lots of in-house development.
So it's a real battleground.
It's absolutely fierce. It's like a two-front war for QuantumScape.
Yeah.
They have to beat other solid-state startups and prove they're significantly better than the ever-improving lithium-ion batteries from the giants. It can't just be a small step up. It has to be that no-compromise leap.
And just for scale, you mentioned QS is worth about $4.5 billion. What about the others?
Right, so QS around $4.45. Solid power, SLDP is much smaller, maybe $7.7 billion. SES AI even smaller, $0.4 billion. Enovix, ENVX, another player, around $2 billion. But then you look at CATL, they're well over $100 billion. So massive difference in scale compared to the big incumbents.
Okay, a crowded field. Are there any sort of external factors helping or hindering them?
Regulations, government support. Yeah, there are. On the regulatory side, they have to meet stringent standards. UL for safety, OSHA for workplaces, EPA for environment. That's standard. But there are macro tailwinds, like the U.S. Inflation Reduction Act, the IRA.
Ah, the tax credits.
Exactly. Tax credits for building out a domestic battery supply chain. But that could definitely help companies like QuantumScape if they manufacture components here.
So that's a potential boost. But getting into this business must be incredibly hard, right?
Mhm.
What are the barriers to entry?
Extremely high barriers. First, the technological complexity. Solid-state batteries, especially lithium metal ones, have historically struggled with things like dendrite formation, little metallic spikes that can cause shorts. Solving that reliably is tough.
Okay, the science is hard.
Second, manufacturing scale-up. Going from making prototype cells to making millions or billions of identical, high-quality cells reliably and cheaply. It's a monumental engineering challenge. Yeah. Think about making those ceramic separators maybe 20 microns thick, perfect every time, millions of times.
Yeah, that sounds incredibly difficult.
Third, capital intensity. Even with a licensing model, building pilot lines and initial production facilities costs hundreds of millions, potentially billions eventually.
Huge upfront investment.
And fourth, lengthy automotive qualification. Cars have incredibly long development cycles and safety requirements. Getting a new battery chemistry qualified by an automaker takes years of rigorous testing.
So it's incredibly difficult to even get in the game. Given all that, what gives QuantumScape its edge? What are their competitive advantages?
They do have some distinct advantages. One is brand strength and recognition. They got a lot of attention from their SPAC debut, having high-profile backers like Bill Gates and, of course, that deep Volkswagen relationship.
They're definitely well known in the space.
Two, potentially cost advantages. If they can scale the Cobra process successfully, that anodeless design could give them a structural cost advantage by eliminating graphite and related steps. Big if on the scaling, though.
Right, hinges on manufacturing success.
Three, network effects and switching costs, primarily through that Volkswagen PowerCo partnership.
Yeah.
It's been going since 2012. They have joint teams, huge investment, shared milestones. That deep integration creates very high switching costs for VW. The goal is to build a whole global ecosystem around their tech.
So VW is deeply committed.
Seems that way. And finally, four, unique assets and capabilities. Their IP portfolio, over 200 patents and applications covering the ceramic separator, the anodeless architecture, the manufacturing processes. They definitely have a first-mover advantage in this specific type of solid-state battery.
Okay, that makes sense. Let's shift gears now to Chapter 2, Management Evaluation. For a company at this stage, the team leading the charge is absolutely crucial. Tell us about the leadership. Who's running the show?
Right, the leadership is key. The current CEO is Dr. Siva Sivaram. He took over in February 2024.
Relatively new CEO, then. What's his background?
Very relevant, actually. He comes from the semiconductor and data storage world, Western Digital, SanDisk, Intel. His expertise is really in scaling up complex, high-precision manufacturing processes.
Ah, so exactly the challenge QuantumScape faces now.
Precisely. It seems like a strategic hire for this phase of the company moving from R&D towards mass production. The founder, Jagdeep Singh, who was CEO until Sivaram took over, is now the chairman.
Singh was the original visionary, right? Got the VW deal, took them public via SPAC.
That's him, still involved as chairman, providing that continuity and vision.
How has the leadership handled crises? I remember there was a short seller report back in 2021.
Yes, that was a big test. Scorpion Capital put out a report in April 2021, basically calling QuantumScape a pump-and-dump SPAC, alleging they were exaggerating their tech readiness.
Ouch. How did they respond?
Jagdeep Singh, CEO at the time, went on CNBC pretty quickly. He strongly defended the company, called the claims absurd, emphasized their commitment to transparency and data, and pointed to their validation by third parties in VW.
Did it work?
It helped stabilize things. Volkswagen's continued public support and investment was absolutely crucial in navigating that period. But, once doubt is cast, some level of skepticism tends to linger in the market.
Understandable. So navigating a short seller attack is one thing. What about just ongoing transparency? And are there any sort of ethical concerns or red flags around management?
Well, on the formal side, they have the usual stuff. An investor relations website, SEC filings, quarterly earnings calls with Q&A. They have a formal code of conduct.
Standard corporate governance.
Right. But, and this is a really crucial point for investors, there's the issue of insider selling.
Ah, you mentioned this might come up. What's the story there?
There's been a consistent and frankly heavy pattern of selling by insiders, executives, and directors. Looking at the past 12 months, there were something like 82 sell transactions versus only 23 buy transactions.
Wow, that's quite a ratio.
And the net amount is significant. In just the last 3 months leading up to our data point, insiders sold a net of over 3.5 million shares.
3.5 million shares sold by insiders recently. Who's selling?
It includes directors like Fritz Prince, the Chief Legal Officer Michael McCarthy, the Chief Development Officer Mohit Singh. often selling shares worth hundreds of thousands of dollars at a time.
That does seem like a potential red flag.
It definitely raises questions. When you see top executives consistently selling large amounts of stock, it creates a disconnect with the public message about massive future potential. It makes you wonder about their own long-term conviction.
Yeah, that's a head scratcher. Selling shares while talking up a multi-trillion-dollar opportunity. So where is the company's money going? How are they allocating capital?
It's pretty straightforward. Nearly 100% is focused on developing the core technology and getting it ready for commercialization.
All in on the tech.
Pretty much. R&D spending is the big one. It's been growing aggressively from $65 million back in 2020 to $383 million in 2024. In Q2 2025 alone, it was $101 million. That's the lifeblood of the company right now.
Makes sense for their stage. What about building things, capital expenditures?
CapEx is guided at $45 to $65 million for the full year 2025. That's mainly going into upgrading their pilot manufacturing lines in San Jose, specifically for that QSE-5B sample production.
So focused investments, not just spraying cash around.
Right. And importantly, there's no history of M&A, no share buybacks, no dividends. Growth is purely organic, funded by equity raises and those partnership payments from VW and others like Mirage.
Okay, so all the cash is going into building the future. How do we measure financial returns for a company like this? One with no revenue yet. Things like ROIC.
Yeah, traditional return metrics like return on invested capital, ROIC, are deeply negative.
Yep.
You see numbers ranging from -4% to over -100%.
Which sounds terrible.
But it's actually completely expected for a pre-revenue company that's investing hundreds of millions in R&D and CapEx.
Right, they have to spend money to hopefully make money later.
Exactly. The negative ROIC today isn't the story. The key is the future trajectory. Investors are betting that once commercial revenues start flowing, hopefully around 2027, 2028, that ROIC will turn positive and eventually become very attractive due to the potentially high margins of the licensing model. But today, it's all about the investment phase.
Got it. Okay, that leads us nicely into Chapter 3. Financial analysis. Let's dive into the numbers, or perhaps the lack thereof, given their stage. What are the key metrics we should be looking at?
Right. Well, as we've said, the headline numbers look unusual for a multi-billion-dollar company. Market cap, as of September 8, 2025, around $4.45 billion. But that's based purely on future potential, not current performance.
Because current performance is
Zero revenue. For the last 5 fiscal years, projections suggest revenue might start in 2027 or 2028. So revenue growth, not applicable. Profit margins, also not applicable.
So instead of profits, we look at losses.
Yeah.
Cash burn.
Exactly. Operating losses are significant and have been growing as they ramp up R&D. The net loss for the trailing 12 months was about $463 million. Q2 2025 alone saw a net loss of around $115 million.
Burning through a lot of cash.
Yes, and free cash flow, FCF, tells a similar story. Consistently and significantly negative. TTM FCF was negative $370 million. Q2 2025 FCF was negative $70 million. This just underscores their complete reliance on the cash they've raised from investors.
Okay, negative numbers everywhere, but as you said, that's the nature of the beast for a company like this. How stable are they financially? Can they sustain this burn?
This is actually a relative bright spot. Their financial stability looks quite strong, primarily because of how they've been funded.
How so?
Their debt-to-equity ratio is very low, around 0.09 or 8.7%. This means they've overwhelmingly financed themselves by selling stock equity, not by taking on debt.
Which means no big interest payments to worry about.
Correct. That removes a major source of financial pressure. And then there's their liquidity, measured by the current ratio.
How does that look?
Exceptionally high, actually.
Yeah.
Around 16.4. That means they have about $16 in short-term assets, mostly cash and equivalents, for every $1 in short-term liabilities. Bills due soon.
Wow, 16 to 1. That's a huge cushion.
It is. It indicates very robust liquidity. And the most crucial data point that stems from this is their cash runway.
How long can their current cash?
As of the end of Q2 2025, they had nearly $800 million in liquidity. Management has guided that this cash is expected to last them into 2029.
Into 2029? That's quite a long runway.
It is. It's a critical factor for a pre-revenue company. It gives them years to potentially hit their milestones without needing to immediately go back to the market for more cash, especially if market conditions aren't favorable.
Okay, that's impressive liquidity for a company burning so much. Now, the really tricky part, valuation. How on earth do you value a company with no earnings or sales?
Yeah, it's tough. As we noted, traditional relative valuation metrics like price to earnings, PE, or price to sales, PS, are completely meaningless here. Zero sales, negative earnings.
So what do you use? Crystal ball.
Yeah, feels like it sometimes. The main tool is intrinsic valuation using a discounted cash flow, or DCF, model.
DCF, can you explain that simply?
Sure. The basic idea is you project the company's future free cash flows, all the cash it's expected to generate years down the road, if it becomes successful and profitable. Then you discount those future cash flows back to their present value, using a discount rate that reflects the riskiness of those projections. The sum of those discounted future cash flows is the theoretical intrinsic value.
Okay, makes sense in theory. But for QuantumScape.
For QuantumScape, a DCF is less a precise calculator and more a framework for disciplined speculation, as some might put it. The output is extremely sensitive to the assumptions you make.
What kind of assumption?
Huge ones. When will revenue actually start? 2027, 2028, later. How fast will it grow? You have to assume incredibly high growth initially, then tapering off. Will they ever be profitable? You have to model a path from huge losses today to stable, positive operating margins in the future. What will those margins be?
Lots of guesswork involved.
Absolutely. And the most critical and subjective assumption is the discount rate. Because QuantumScape is so risky, huge technological risk, huge execution risk, you need to use a very high discount rate. Maybe 20%, 25%, even 30%. A higher discount rate dramatically reduces the present value of those distant future earnings.
So changing that discount rate slightly could massively change the valuation.
Massively. That's why, for educational purposes only, not a price target. A DCF for QS might spit out a very wide hypothetical intrinsic value range, something like, say, $4 to $12 per share.
Wow, $4 to $12, it's a huge range.
It reflects the enormous uncertainty. The low end assumes significant delays or maybe only moderate success. The high end assumes they execute incredibly well and capture a large chunk of the market. It just illustrates the binary nature of this bet.
Understood. Not a prediction, just a way to frame the potential outcomes. That brings us nicely to Chapter 4, market sentiment. With such uncertainty, how is Wall Street and the broader market reacting? What are analysts saying?
Well, as that wide potential value range suggests, analyst views are deeply polarized. It's quite striking.
How polarized?
One-year price targets are all over the map. The low target might be around $2.52, while the high target could be up at $11.55. The average target tends to hover somewhere around $6.15 to $6.35.
So some analysts think it's going way down, others think it could almost double, and the average is below the current price.
Exactly. And the consensus rating reflects that caution. You mostly see hold or reduce ratings, very few outright buy recommendations.
Yeah.
One survey showed maybe 15% buy, but 38% sell or strong sell, and 46% hold.
A truly binary stock, it seems. Low targets bake in failure, high targets bake in success.
That's pretty much it. The market sentiment is highly reactive to news flow as well. It's like a constant tug of war between the promise and the execution reality.
How do news events sway the price?
Positive news about technical progress can cause big surges. Remember that Ducati motorcycle demo they did using their cells at a mobility show? The stock jumped over 20%.
I remember that.
Or hitting milestones like the Cobra separator production baseline. That provides temporary boosts. But then negative catalysts like reports of insider selling, analyst downgrades, or any perception of delays can cause sharp drops. The narrative shifts really quickly.
It's fascinating how sensitive it is. Beyond the headlines and analyst ratings, what do technical indicators tell us about sentiment? Things like short interest.
Short interest is a big one for QuantumScape. It's consistently high. Around 52.14 million shares were held short as of our data point.
52 million shares short. What does that represent?
That's about 12.09% of the float, maybe even higher depending on the source, sometimes cited closer to 14-15%. That's significantly higher than both stocks and higher than its direct peers.
So a substantial chunk of the market is actively betting against the stock.
Correct. It indicates significant skepticism.
Yeah.
However, the days to cover how long it would take for all shorts to buy back their shares based on average volume is often around 5 to 10 days.
What does that imply?
It suggests that if there is significant positive news, it could potentially trigger a short squeeze, where shorts rush to cover their positions, driving the price up rapidly. It adds another layer of volatility.
Okay, high short interest, potential for a squeeze. What about moving averages?
Here again, we see conflicting signals, which perfectly captures the debate. The share price, $7.86 at the time, was below its 50-day simple moving average, $9.09. That's typically seen as a bearish signal for this short-term trend.
Okay, short-term bearish.
But the share price was above its 200-day simple moving average, $5.76. That's often interpreted as a bullish signal for the longer-term trend.
Below the 50-day, above the 200-a-day, so confusion.
Exactly.
Yeah.
It perfectly encapsulates the market's struggle, long-term optimism about the potential versus short-term doubt and serious concerns about execution and timing. The technicals mirror the fundamental debate.
Interesting how that works out. Okay, let's turn to Chapter 5, ownership structure. Who actually owns QuantumScape, and what does that tell us?
Looking at the stakeholder analysis, institutional investors hold a pretty significant chunk, somewhere between 33% and 38% of the shares.
Who are the big players there?
The single largest and arguably most important shareholder is Porsche Automobile Holding SE. That's part of the Volkswagen Group. They hold around 15.2%.
That's VW's strategic stake, the foundation of the partnership.
Absolutely critical. After them, you have the usual large index fund managers. The Vanguard Group is the largest institutional holder overall, with about 6.4%, mostly passive funds. BlackRock is also a major holder, around 3.0%, again, largely passive index money.
So VW strategic, then Vanguard and BlackRock passive. Any others stand out?
Yeah, some of the early venture capital backers are still significant holders. Capricorn Investment Group has about 2.6%, and Khosla Ventures holds around 2.3%. They got in early.
Okay, a mix of strategic partners, passive giants, and early VCs. But what about the people closest to the company, the insiders?
Right, insiders, the executives and directors collectively own a substantial amount, somewhere between 7.8% and 8.9%. So they do have skin in the game.
That seems like a decent alignment of interests.
It would seem so, however. This brings us back to that critical issue we discussed earlier, the pattern of consistent and heavy insider selling.
Right, the 82 sells versus 23 buys.
Exactly. Over the last 12 months, that net disposition of over 3.56 million shares in just the last 3 months. It's hard to ignore.
It really does act as a powerful counter-narrative to the public optimism.
It does. When you see multiple top executives regularly selling significant amounts of stock, regardless of the stated reasons, like planned selling programs, it inevitably raises serious questions for outside investors about their true belief in the company's long-term trajectory versus its current valuation.
So what does this ownership structure, VW's big stake, passive funds, insider selling, mean for smaller retail investors?
Well, one key aspect is ownership concentration. The top 11 shareholders own over 50% of the company. The top 25 own nearly 49%, according to another source. Regardless, it's highly concentrated.
What are the implications of that concentration?
It means that major strategic decisions can be heavily influenced, if not dictated, by a relatively small group of large shareholders, particularly the strategic partner, Volkswagen. The interests of smaller retail investors might not always be the primary consideration when big corporate decisions are made.
Something for individual investors to keep in mind. Okay, let's move into Chapter 6, risk assessment. Every high-potential company comes with high risks. A SWOT analysis seems appropriate here. Let's start with the positives. What are QuantumScape's core strengths?
Okay, strengths. First and foremost, S1, pioneering technology. That innovative solid-state anode-less battery has the potential for a genuine step change in EV performance. It's not just incremental.
The core tech itself.
Second, strong intellectual property portfolio. Over 200 patents and applications protecting that core tech and manufacturing processes. That's a significant moat, potentially.
Hard for others to copy directly.
Third, S3, key strategic partnership. That deep, long-standing, financially significant relationship with Volkswagen Group is huge. It provides capital, technical validation, and a clear path to market if the tech works.
The VW anchor.
And fourth, robust balance sheet. As we discussed, nearly $800 million in liquidity, very low debt, and that multi-year cash runway into 2029. That financial cushion is a major strength for a pre-revenue company.
Okay, strong foundations. But every company has its challenges. What are the internal weaknesses we need to consider?
The weaknesses are significant too. Number one is clearly W1, pre-revenue status and high cash burn. No revenue means total reliance on investor capital. Burning hundreds of millions a year makes the business inherently fragile if sentiment turns or milestones are missed.
Dependent on external funding.
Two, and this is arguably the biggest one, W2, unproven manufacturing at scale. They simply haven't proven they can make these advanced cells in high volume, with high quality, and at a competitive cost. This is the monumental engineering challenge and the greatest execution risk. History is littered with battery companies that failed at this stage.
The scale-up hurdle.
And third, W3, long and uncertain development timeline. They've had shifts in timelines before. there's always the potential for further delays, which can erode investor confidence and give competitors more time to catch up.
So execution on the plan is the biggest internal hurdle. Looking outward, what opportunities are out there for them if they can overcome these weaknesses?
The opportunities are potentially enormous. First, obviously, O1, massive and growing EV market. It's a multi-trillion-dollar global market undergoing a once-in-a-century industrial transformation. Capturing even a fraction of that would be huge.
Electrification wave.
Second, O2, scalable licensing business model. If they succeed technically and their partners can manufacture, that capital-light licensing model allows for rapid global scaling without QS needing to build all the factories themselves. High potential margins.
Leverage partners for scale.
And third, O3, expansion into adjacent markets. Beyond EVs, this kind of battery tech could be valuable in consumer electronics. Think safer, longer-lasting phone batteries, stationary grid storage, potentially even electric aviation or robotics down the line. Lots of future potential beyond cars.
The potential is definitely vast, but so are the external threats. What should we be concerned about on that front? What general external challenges do they face?
Top of the list is T1, intense and well-funded competition. We talked about this other solid-state startups, the established battery giants constantly improving Li-ion, major automakers doing their own R&D. It's a brutal race.
Everyone wants to win the battery race. Second, T2, risk of technological obsolescence. Battery tech is evolving incredibly rapidly. There's always a risk that someone else may be using a different chemistry or approach, comes up with something even better or significantly cheaper, making QS tech less competitive before it even fully scales.
Leapfrogged by another breakthrough.
And third, related to the weaknesses, is just the overarching T3 execution and commercialization risk. The risk that they simply fail to meet their technical milestones, fail to scale production effectively, or fail to hit the cost targets required to be competitive in the mass market. This is the fundamental threat.
Okay, those are big strategic threats. What about broader macroeconomic factors? How do things like inflation or interest rates impact a company like QuantumScape?
They have a significant impact, especially on a pre-revenue company. Inflation increases their costs. Raw materials like lithium and ceramics get more expensive. Building facilities cost more. This could squeeze future margins if they ever get there and potentially delay profitability.
Higher costs hurt. What about interest rates? Interest rates are particularly crucial for a company like QS, whose entire value is based on distant future earnings. When interest rates rise, the discount rate used in those DCF valuations goes up. You mentioned maybe 20–30% for QS.
Right, reflecting higher risk and opportunity costs.
Exactly. And a higher discount rate disproportionately hammers the present value of earnings that are many years away. So rising rates put significant downward pressure on the valuation of long-duration, speculative assets like QuantumScape.
More sensitive to rate hikes than established, profitable companies.
Much more sensitive. And finally, specific geopolitical factors matter too. Think about the global battery supply chain.
Heavily reliant on China for materials and processing.
Precisely. So things like U.S.-China tariffs can be a threat. For example, potential new U.S. tariffs announced in 2025, like maybe a 25% tariff on natural graphite starting in 2026. Even though QS is anodless, disruptions to other parts of the supply chain or general trade friction can increase costs and complicate scaling efforts.
So trade tensions add risk, even if they have that IRA tailwind domestically.
Right. It's a complex global picture.
Okay, we have definitely covered a lot of ground. Let's pull all these threads together now for Chapter 7. Conclusion. Can you summarize the key bullish points? Why might someone be optimistic about QuantumScape?
Sure. The bull case boils down to a few key pillars. First, the disruptive technology. It really is a potentially revolutionary solid-state battery platform. They have a strong patent moat around their specific approach, and it holds the promise of solving those key EV pain points: range, charging, safety.
The tech itself is exciting.
Second, the massive total addressable market. Electrification is a multi-trillion-dollar global shift. The potential reward for success is enormous.
Huge market opportunity.
Third, premier partner validation. That deep commitment from Volkswagen Group financial, technical, commercial is a massive vote of confidence and provides a crucial pathway to scale.
VW's backing is key.
And fourth, the strong financial position. That healthy balance sheet, low debt, and long cash runway give them time and resources to navigate the difficult path ahead. They aren't facing imminent financial collapse.
Okay, that sounds incredibly promising on paper. But, as we've emphasized, there's definitely another side to this coin. What are the core arguments for the bear case? Why be pessimistic?
The bear case is equally compelling, frankly. Number one is the extreme execution risk. They simply haven't proven they can achieve high-volume, cost-effective mass production. This is the historical graveyard for promising battery technologies, and it remains their biggest hurdle.
The manufacturing challenge looms large.
Two, the high and sustained cash burn. Burning hundreds of millions a year with zero revenue makes them perpetually reliant on capital markets or partner funding. Any stumble could force them to raise cash at unfavorable terms.
Reliant on external cash.
Three, that persistent insider selling. It's hard to ignore. The consistent large-scale stock sales by top executives raise serious questions about their own conviction in the long-term story versus the current stock price.
The insider selling sends a worrying signal.
And four, intense competition. They face threats from other well-funded solid-state startups and, critically, from established giants who are continuously improving conventional Li-ion tech, potentially narrowing the performance gap before solid-state is even ready for prime time.
A tough competitive field. So we have this incredibly polarized picture, groundbreaking potential versus immense risk. What does this all mean for the value of the company right now? Where does that $7.86 share price sit in this context?
Right. As we discussed, traditional metrics are useless. Our educational DCF exercise suggested that very wide intrinsic value range, maybe $4 to $12 per share. Again, emphasizing this isn't a prediction, just an illustration of the huge uncertainty.
And the current price is right in the middle of that range.
Exactly. The $7.86 price falls squarely within that wide range.
Yeah.
What this suggests is that the market is currently trying to balance that enormous potential against the profound risks. It's not pricing in total failure, the price isn't near zero, but it's certainly not pricing in flawless execution either. It's well below hypothetical blue sky scenarios.
So the market is acknowledging both the dream and the danger.
I think that's a fair assessment of where it stands today.
This raises the ultimate question then. What kind of investment is QuantumScape today? How should someone think about it?
At the end of the day, an investment in QuantumScape right now is really a high-risk, high-reward, venture capital style bet made in the public markets.
Venture capital style, meaning?
Meaning it's not a traditional value investment based on current earnings or assets. It's a bet on future technological success and massive market disruption. The outcome is likely quite binary. If they succeed in overcoming these huge hurdles and commercialize effectively, the gains could be substantial. But if they fail to deliver, if the tech doesn't scale, or if competitors surpass them, the potential for significant loss of capital is very real.
Binary. Big win or big loss potential. Not much middle ground expected.
That seems to be the most probable scenario landscape, yes.
So what does this all mean for you, our listener? It means understanding QuantumScape is really a deep dive into the bleeding edge of EV technology. It's about whether a truly breakthrough innovation can conquer these monumental engineering, manufacturing, and market challenges.
A fascinating case study, regardless of the outcome.
Absolutely. And here's a provocative thought to leave you with. If QuantumScape does pull this off, how quickly could their technology reshape not just the car industry, but maybe our whole energy landscape? What happens to the existing battery giants then?
Yeah, the ripple effects could be enormous.
And conversely, what if they stumble? What if this specific innovation falls short? Are there other revolutionary battery technologies waiting in the wings, ready to leapfrog them and take center stage? The race is far from over.
Definitely something to keep watching.
Well, thank you for joining us on this deep dive into the complex world of QuantumScape. We really hope this has given you a clearer, more nuanced understanding of this fascinating, high-stakes company.
Hope it was helpful.
And if you found this valuable, please do remember to like and subscribe to Stock Analytics AI. Members, again, €4.99 a month gets you priority deep dives on tickers you choose. We are covering all the S&P 500 stocks, and members get that exclusive priority access.
Great way to get specific stocks covered.
And if you just want a one-off deep dive, drop us a super thanks. We always appreciate the support.
And remember, knowledge is powerful, but most valuable when you understand it deeply and can apply it. Keep thinking critically.
Absolutely. Just a final, quick, but important note. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice.
Please do your own research.
Yes. Always conduct your own research or consult with a qualified financial advisor before making any investment decisions. Until next time, keep diving deep.